While most people go about their day, the world's largest economy is confronting a pressure it hasn't faced in generations: a $35 trillion debt load, rising interest costs, and a global financial system that is slowly beginning to look elsewhere for stability. For decades, the US dollar has sat at the center of world finance, unchallenged, unquestioned, untouchable. But something has broken. The shield America has relied on is thinning, confidence is slipping, and in Washington, a new strategy is emerging, one that hardly anyone is talking about. A strategy that involves gold, cryptocurrency, stablecoins, and a potential reset of how the US government funds itself. Tonight, we're going to look at what's really happening behind the scenes, why America is quietly embracing digital dollars, what it means for the future of the dollar, and how this shift could reshape global finance for decades. Because the reset isn't coming, it has already begun. So now, hit subscribe and step with me into the story. For most of modern history, the United States has enjoyed something no other country possessed: the privilege of issuing the world's default currency. It meant that when nations traded oil, they did it in dollars. When central banks built their reserves, they held dollars. When businesses borrowed internationally, they turned to dollar markets first. This global demand became a financial superpower, one that allowed America to borrow endlessly, spend aggressively, and run deficits that would break almost any other nation. The world trusted the US dollar, and that trust created a steady, almost gravitational pull toward US Treasury debt. But trust, like any form of capital, isn't guaranteed forever. Over the last few years, subtle cracks have begun to appear. Quiet at first, barely noticeable but unmistakable to anyone watching the data. The share of global foreign exchange reserves held in US dollars, once comfortably above 60% for decades, has slipped to its lowest point in 30 years. No crisis, no collapse, just a gradual, persistent erosion. It's the kind of slow drift that rarely makes headlines, yet can reshape the global order. Part of this change is structural. Emerging economies are growing faster than the US, diversifying their reserves and experimenting with alternative payment systems. Part of it is political countries wary of relying too heavily on a system the US can sanction or freeze. And part of it is simply mathematical. The world is shifting, and reserve composition is shifting with it. For the United States, this is more than a symbolic loss. It strikes at the very heart of its financial engine. Because the dollar's dominance has always kept America's borrowing costs low. As long as the world demanded treasuries, interest rates stayed suppressed, even when US debt ballooned. But with demand slipping, the equation is changing. The privilege is no longer absolute, and America is beginning to feel what every other nation already knows. When confidence fades, the cost of money rises. As the dollar's dominance quietly slips, the United States is facing another problem, one that moves much faster, hits much harder, and can't be ignored: interest rates. For nearly 2 decades, America lived in a world of near-zero borrowing costs. Money was cheap, debt felt harmless, politicians could approve trillion-dollar packages without worrying about the long-term math. And for a while, the markets rewarded that behavior. Investors still believed the US was the safest place to park their capital, but that world is gone. Over the past few years, US government interest rates have climbed to levels not seen in 20 years. Suddenly, a mountain of old debt issued when rates were low is rolling over at much higher costs. And the numbers are staggering. In just 5 years, the government's annual interest expenses have jumped from around $500 billion to more than $1.2 trillion. That means over 1/5 of every dollar America collects in revenue now goes toward nothing more than paying interest. Not education, not infrastructure, not healthcare, just interest. This is where the spiral begins. Economists call it the debt doom loop, a cycle where rising debt leads to rising interest rates, which make the debt even more expensive, which weakens the budget, which erodes investor confidence, which pushes rates even higher. Most countries that fall into this loop face harsh consequences: currency devaluation, austerity, political instability. The US has avoided that fate for decades because its debt was backed by unparalleled global trust, but with confidence weakening and borrowing costs rising, the protection is thinning. The loop hasn't tightened around the economy yet, but the mechanism is already in motion. And if something doesn't break this cycle soon, the world's most powerful economy could find itself caught in a financial gravity it can no longer escape. If rising interest rates are the storm you can see, then the term premium is the pressure building in the shadows, quiet, invisible, and capable of shaking the entire financial system when it finally moves. So what is it? Think of the US government borrowing money the way you might take out a long-term loan. Part of your interest rate depends on inflation. Another part depends on short-term rates set by the Federal Reserve. But the final piece, the term premium, is different. It's the trust factor. It's the extra return investors demand for locking their money away in US debt for 10 long years. When trust is high, that premium shrinks. When trust is low, it rises. In 2019, confidence was so strong that the term premium actually went negative. Investors were so eager to hold US bonds that they accepted a lower return than the market average. It was the financial world's version of saying, "We trust you completely." Today, that number sits around 0%, not positive, not negative, just sitting still, almost unnaturally still. Because historically, the term premium averages around 2%. And if it moves back to that normal level, just normal, not extreme, America's 10-year interest rate could jump from 4% to about 6%. That alone would hit nearly everything. Mortgage rates, business loans, government refinancing costs, the budget deficit. For Washington, it would add hundreds of billions in extra interest expenses, instantly tightening the debt spiral. That's why the term premium is so dangerous. The US is running a $35 trillion debt based on today's unusually calm market conditions. But calm conditions don't last forever. They never do. And when investor confidence finally shifts, whether due to geopolitics, inflation, or political gridlock, the term premium will rise. And when it rises, the entire cost of running America rises with it. For decades, the United States enjoyed an unspoken partnership with two of the world's largest economies, China and Japan. They produced, America consumed, they earned dollars. America issued debt, and in a financial dance that benefited both sides, those dollars eventually found their way back into US Treasury bonds. This cycle helped anchor America's borrowing costs. Whenever Washington issued new debt, China and Japan were their ready buyers, stabilizing forces, pillars of global demand. But that era is ending. Quietly, and with little public attention, both nations have shifted from net buyers of US debt to net sellers, not just reducing purchases, actively unwinding the very holdings that once supported America's financial dominance. For Japan, rising interest rates at home have created more attractive domestic yields. Why buy US bonds at 4% when Japanese bonds, once yielding near zero, now offer meaningful returns? For China, the shift is more strategic. Geopolitical tensions, trade conflicts, and concerns over sanctions have pushed Beijing to diversify away from the dollar. Holding too much US debt is no longer seen as safe, it's seen as a liability. And while these decisions are rooted in domestic priorities, their effect on the United States is profound. Together, China and Japan were among the largest foreign holders of US Treasuries. Their retreat leaves a widening gap, one the US cannot easily fill. Because unlike past decades, there are no new giant buyers waiting in line. As foreign demand weakens, America must rely more heavily on domestic investors or pay higher yields to attract new ones. Both paths mean higher interest costs, more strain on the federal budget, and more pressure feeding into the debt doom loop. The world isn't abandoning the dollar all at once, but the slow withdrawal of its biggest backers signals a shift that Washington can't control and can no longer ignore. With foreign buyers stepping back and borrowing costs rising, Washington has begun searching for a new source of demand, something fresh, scalable, and ideally outside the traditional geopolitical chessboard. And surprisingly, they may have found it in crypto. Not Bitcoin, not Ethereum, but stablecoins, the digital dollars quietly spreading across the global economy. Stablecoins like USDT and USDC are simple in theory. Each digital token is backed by one real US dollar, or more commonly, a US Treasury bill. They move faster than bank wires, cost less than international transfers, and operate 24 hours a day. For millions of people around the world, especially in unstable economies, they've become a lifeline to the US dollar. But what most people don't realize is this. Behind every stablecoin in circulation is real demand for US government debt. When Tether or Circle issues new tokens, they must buy more Treasury bills. As stablecoin use grows, so does their appetite for American debt. And that appetite has exploded. In just a few years, stablecoins have reached a market cap of roughly $200 billion, making their issuers some of the largest non-government holders of U.S. Treasuries comparable to entire nations. Washington has taken notice. For the first time, lawmakers and regulators are giving serious attention to stablecoin legislation, setting guardrails, encouraging institutional issuers, and promoting a framework that could let the sector scale safely. Why? Because if stablecoins grow to the projected $2 trillion market cap, their issuers could become the single largest buyers of U.S. debt in the world, surpassing even China and Japan combined. In a moment when traditional demand is fading, this isn't just a technology trend, it's a lifeline, an entirely new playbook for maintaining global dollar dominance. The United States may be losing foreign governments, but it's gaining millions of digital dollar users around the world, and this shift is reshaping the financial battlefield in ways few people understand. On the surface, the idea sounds almost elegant. If foreign governments won't buy enough U.S. debt, then millions of individuals around the world armed with smartphones and stablecoins might take their place. And in some ways, the plan is already working. From Latin America to sub-Saharan Africa to Southeast Asia, stablecoins have become the digital escape hatch for people trapped in failing currencies. When inflation hits 30%, 50%, even 100% a year, holding dollars even in digital form feels like salvation. Demand for stablecoins in these regions is growing at double-digit rates annually, creating a new, decentralized base of support for the US dollar. It's a striking reversal. Foreign governments are stepping back, but ordinary citizens in emerging markets are stepping forward. But here's the catch, the part of the story Washington doesn't say out loud. The US national debt isn't just large, it's too large. At $35 trillion, even a booming $2 trillion stablecoin market would cover only a fraction of America's borrowing needs. Stablecoins can offset some lost demand, but they cannot single-handedly support an ever-growing mountain of debt. And markets know this, because while the crypto ecosystem expands, another force is rising alongside it: gold. Investors have pushed gold into one of the strongest rallies in modern history, a clear sign that many are hedging against currency debasement and questioning the long-term strength of the dollar. Bitcoin tells a similar story. So do capital flows exiting U.S. Treasuries. Stablecoins may strengthen the dollar's global reach, but they cannot fix fiscal policy, reverse chronic deficits, or stop a debt spiral on their own. They are a tool, powerful, strategic, and useful, but not a cure. The real question isn't whether stablecoins can save the dollar. It's whether the U.S. can control its spending long enough for this new digital demand to matter. The remarkable thing about financial resets is that they rarely announce themselves. They don't arrive with a single headline, a market crash, or a presidential address. They begin quietly through shifting incentives, subtle policy moves, and changes in where people place their trust. And today, those signals are everywhere. Gold is breaking records, climbing with a momentum that only appears when investors sense currency erosion. Bitcoin is surging as capital looks for alternatives beyond government control. Foreign governments are trimming their exposure to U.S. debt, even as millions of individuals in emerging markets are adopting digital dollars through stablecoins. The world isn't rejecting the dollar, but it is renegotiating its relationship with it. America's answer: the crypto reset, the embrace of stablecoins, the attempt to rebuild global demand through digital rails, isn't a conspiracy or a secret plan. It's simply the next evolution of a financial system trying to protect itself from its own vulnerabilities. But no matter how innovative the tools, no reset can succeed without one essential element: trust. And trust depends on discipline, fiscal, monetary, and political. If the U.S. can restore that discipline, stablecoins could become one of the most powerful extensions of the dollar ever created. If not, the world will keep looking to gold, Bitcoin, and other assets that exist outside government reach. That's the crossroads we're standing on, a moment when technology, policy, and global economic forces are converging to reshape the next decade of money. So let me ask you, do you think the crypto reset will strengthen the dollar, or is this just the beginning of a much larger shift away from U.S. dominance? Share your thoughts below. I read every comment. If you found this breakdown valuable, make sure you subscribe to the channel. We dive deep into macroeconomics, financial strategy, and the hidden forces shaping global markets every single week. The information presented in this video is intended solely for educational purposes and should not be interpreted as financial advice. Your outcomes may differ depending on your own efforts and market conditions. Thanks for watching, and I'll see you in the next one.